Hi, I'm Nate Ekman. I'm an analyst here at ValueLine. I'm joined today by two other senior analysts, Alan House and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Wall Street has no investment banking business with any company, including all the equities under our coverage. ValueLine does not execute trades for its subscribers and, therefore, has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-ValueLine. Now, let's discuss the economy and the stock market. This content was prepared by ValueLine's economic staff. The latest reading on the Consumer Price Index, or CPI, showed inflation remains sticky. Specifically, the CPI and the core CPI, which excludes the more volatile food and energy components, rose 0.3% and 0.4% respectively in January. On a 12-month basis, the CPI and core CPI increased 3.1% and 3.9% respectively. All figures came in above consensus forecasts. The data-driven Federal Reserve will probably not be in a rush to pivot on the monetary policy front. That is because consumer prices are still rising and the economy continues to expand at a solid pace, as reflected in an annualized gross domestic product advance of 3.3% during the final quarter of 2023. This, coupled with the strong job gains during the first month of this year, during which non-farm payrolls rose by an estimated 353,000 positions in January, and the unemployment rate held steady at 3.7%, has kept the possibility of a recession at bay. The fourth quarter results from corporate America suggest that the economy is on solid footing. Indeed, with 2/3 of the S&P 500 companies having reported results as of the preparation of this report, the vast majority have exceeded consensus revenue and earnings forecasts, with profit growth averaging around 3%. If that figure holds, it would mark the second straight quarter of higher earnings. So, what could cause the Federal Reserve to reverse course on the interest rate front earlier than we expect? We think that the central bank would need to see signs of mounting stress in the banking system or in interest rate sensitive sectors such as commercial and residential real estate to quickly pivot and begin cutting rates before mid-year. It is worth noting that Treasury market yields spiked following the CPI report, which may put further upward pressure on lending rates. In conclusion, the stock market, which was surging on fourth quarter earnings, sold off on the hot January inflation data. In an environment where the Fed may have to keep interest rates high for longer than Wall Street was anticipating, we recommend that investors keep a good portion of their portfolios in cash holdings while looking at the stocks of high-quality companies with strong cash flows. Those entities are best positioned to run their operations and reinvest in their businesses in a higher rate setting. Please refer to the inside back cover of Selection and Opinion in the Value Line Investment Survey for our statistically based asset allocation model's current reading. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desks, we immediately publish a supplementary report that outlines this new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website, which once again is www.valueline.com. I will now show you how to access those reports. Once signed in on the website, head to the dashboard, where I am already located. This is the main landing page for subscribers. Under the Quick Links section, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. Those changes are published each week in our Selection and Opinion newsletter. For those of you who don't know, financial strength along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the Investment Education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move on to the one stock to buy right now. For this, we'll go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields for screening stocks. I should also mention that another 100 or so fields are available, requiring a higher level of subscription. If that interests you, please call 1-800-VALUE-LINE. As noted in our economic analysis, although some challenges remain, things are looking up in 2024. As such, we'll be looking for stocks that are poised to perform well over the year ahead and beyond. We'll start that process by looking at the safety rank in the ratings and ranks section. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. Today, we're going to focus on stocks with a safety rank of 3 or better. By applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 2,084. Next, we're going to filter for timeliness, one of our tried and true measures. Timeliness is a proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. Like safety, it's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will exceed the overall market over the short term, so we're looking at stocks rated 2 or better. By applying that screen, we've trimmed our list to 318 candidates. We would like to find some stocks that may currently be undervalued today. So to do that, we're going to focus on stocks that are trading no more than 20% above their 52-week low prices. Applying that filter, we've reduced our opportunity set to 52 stocks. Of course, stocks trading near their lows aren't worth anything unless they do eventually go up. Thus, for our next criteria, we're going to look at price appreciation potential over the intermediate term. Today, we'll be looking at stocks with appreciation potential of at least 30% to the midpoint of their 18-month target price ranges. For comparison, the median appreciation over that span for all stocks in the value line universe is about 12%. And with that criteria applied, we have reduced our candidates down to just 16 choices. And finally, we are going to screen for 3 to 5 year high total return potential. This figure is derived from an analyst projection of the cash flows, earnings, and terminal valuation of the next 3 to 5 years. For today's selection, we would like to have an annual potential return of 25% or better. With that criteria applied, we are down to 4 possibilities on our list. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of our senior analysts, we prefer and recommend PayPal Holdings, ticker symbol PYPL. Before I click on PayPal, oh, never mind. Seems I clicked on it. However, I do want to note that you can save your screens and revisit them later utilizing the Create Saved Screen button at the top of the screener. Now, let's move forward back to PayPal. And let's take a look at our latest full-page report. PayPal operates one of the world's largest online payment platforms, processing more than $1.5 trillion in transactions in 2023. In addition to its core PayPal platform, the company also offers mobile and web payment systems and e-commerce solutions under several other brands, including Venmo and Braintree. As you can see in the statistical array, which is the area in the center of the report that includes the financial data, our analysts had predicted that the company saw earnings recover in 2023 following a difficult 2022. Indeed, we now know that's exactly what came to pass, with PayPal having reported full-year earnings of $3.84 per share just a few days after we released this report. For the current year, We expect that the good news will continue due to the improving macroeconomic environment. A rising tide lifts all boats, and in this case, many of those boats have PayPal as a passenger, as it gets a piece of every transaction on its platform. PayPal exceeds several of our screening criteria. It holds a rank of 1 for timeliness, indicating strong relative price performance over the year ahead. Its 18-month price appreciation potential of 40% is more than 3 times the current value line median, and 3 to 5 year annual total return potential of between 23 and 36% is likewise impressive compared to the current median of 12.4%, making this a suitable addition for portfolios with a variety of different investment horizons. Overall, we think that PayPal should see solid growth in 2024 and that it has merit as an investment over both the shorter and longer terms. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For that, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand it off to Alan and Charlie. Take it away, guys.
Daniel, this is Alan. Thank you for a good presentation. There's some good questions coming in. The first one was submitted prior to our presentation. It had to do with the timeliness rank and how often our timeliness ranks are updated. And the answer to that question is it depends. We continuously monitor the timeliness ranks of all the stocks that are in our survey. And we have a stats department that does that with the help of the analysts. So it depends. On earnings season, the ranks might change, or not might. They usually change a little more often than during the non-earning season. But generally, it's based on what the price performance has been, what the earnings are, things like that. So there's no concrete answer to that question. It just depends. Sometimes we continuously monitor it, but sometimes the rank can change fairly often on the stock if there's a lot of activity on the stock and a lot of news and things like that. So yeah, so we're on top of that. We monitor continuously. Along the same lines, I see somebody as Nathaniel alluded to with the 18-month total return potential. What differentiates that from the timeliness rank? The answer to that is, Value Line has been known for its time-tested ranking system, which has been around for decades. And it also does a 3 to 5 year target price range. And several years ago, Value Line felt the necessity to include an 18-month or an intermediate term target price range for investors that are looking for, to hold a stock maybe, 18 months to 2 years, somewhere in that range. So that's when we instituted the 18-month, target price range, which many investors have found very helpful. So thank you. Nathaniel?
Yeah. I've got a question here from Richard Hamilton. Is AI really the wave of the future, or is it being overblown? And the answer to that is, it's obviously it's complicated, but in general, if I have to land on one of those two sides, I'm going to say overblown. And there are specific reasons for that that come down to the technical capabilities of the technology as it exists versus profitability. Like broadly, you can break the applications that are available for AI as a technology down into sort of relatively high dollar applications that are also very demanding, like, self-driving, that sort of thing, and lower dollar applications that don't require very much accuracy, like a lot of generative AI stuff doesn't actually require very much oversight, but also the work that it replaces is not terribly expensive. And the problem there is that the technology is not yet accurate enough to perform those high dollar applications without human oversight, which drives up costs. And then when you factor in things like the server costs and potential legal liability around data sets, around all sorts of issues, regulatory headwinds, and I think that there's a bit of an open question as to the long-term profitability of a lot of these applications. Now, to be clear, many are going to be sustainably profitable in the long term, but I think right now a lot of companies are trying to jump on this bandwagon and trying to, brand themselves as AI companies when really the value added to their services by AI is minimal and doesn't even exceed the cost of keeping the servers on. And so I think that there are going to be companies that come out of this winners, but I think that a lot of the companies that are trying to get onto that bandwagon right now are ultimately going to fall off of it.
Thank you, Nathaniel. I saw another interesting question that came up and someone said that they're retired and looking for solid income, solid dividends, I'm sorry, more than growth. And they said, what subscription would they use? We actually have a very good product that's tailored for this type of investor called the Dividend Income and Growth product. It's published monthly. It contains about 12 to 14 featured selections and about 12 to 14 alternative selections. We update a feature selection and an alternative selection each month. It's actively managed, so we generally sell approximately a stock a month in each portfolio to keep it at about the 12 to 14 level. And it's for people that are seeking dividend income and growth. So there is a growth component to it, but there's the vast majority of it's focused on dividend paying companies that are above value line average and that have higher than potential dividend growth potential for the long haul. So it's called the Dividend Income and Growth product. So I just wanted to answer that question, that's tailored to to retire people or people that are seeking, I should say, high dividend income growth potential. Thanks.
Um, let's see. Um, let's see. How frequently do we update the timeliness rating on a stock? That's being, reevaluated every time that a stock, goes to press. So 4 times a year, where that's being published. But it can change. I think potentially even more frequently than that. That's something that the stats department handles, and they're constantly running those. So if you want to find the absolute most current information on that, yes, I would recommend looking online at the stocks, page on the website, because all of the information from stats is fed directly into that page as soon as it's available.
Thank you, Nathaniel. I also saw another interesting question. Somebody asked about our current thoughts on NVIDIA, which is obviously one of the standout performers of the day. And we actually, as we alluded to earlier in our presentation, we do supplementary reports. Every business day, every day the market's open, we depending on the need, we do between probably two to three, if not more, supplementary reports. And NVIDIA is, of course, one of our supplementary reports for today. So if you want to get an update on our thoughts,
Yeah.
Post earnings, you can definitely check that out as well.
Yeah.
And we do actively, check for supplementary reports.
Yeah. And since there seems to be a fair amount of interest in, NVIDIA, AI, that, that sort of thing today, I will mention that we do run our more in-depth articles about that sort of thing among others, in the selection and opinion section of the survey. I actually have an article about AI that will be out in about a month in issue 8. Um, and so if you want to learn more in depth about, you know, say a specific, industry, um, a specific topic, we we run articles in S&O on a variety of subjects constantly. And so that can be a very good place to get information on the most current happenings with those sorts of, very hot topics.
Thank you, Nathaniel. Um, I'm not seeing any more questions. Nathaniel, you see anything out that catches your eye?
Um, nothing, nothing's jumping out right now. Um, uh, you
Well,
got anything, Alan?
no, no, thank you. I was going to say thank you all for joining us. We'll turn it back to Tim.
All right.
Well, thank you, gentlemen. And webinar attendees, thank you for attending today's presentation.